Perfect. Hi, everyone. Thank you for joining us for tonight's webinar, Navigating Student Loan Changes, What You Need to Know for Dental School. My name is Pyle. If many of you don't know me, I am the National President for ASDA. I'm excited to be here, and I'm going to be your moderator for tonight's webinar. As most of you know, the One Big Beautiful Bill was recently signed into law, resulting in several student loan changes for current and future dental students. And we know that obtaining funding for your education is critical in your decision in becoming a dentist in general. In response to these changes, ASDA is committed to bringing you timely and easy to navigate information through webinars like this one, and as well as email communications that many of you received and shared resources as well. We are so excited to welcome you, our speakers this evening. Our very first one is going to be Jonathan Fansmith. He is the Senior Vice President for Government Relations and the National Engagement at the American Council on Education, where he leads federal advocacy efforts on behalf of the nation's colleges and universities. He oversees the American Council on Education's engagement with Congress, federal agencies, and the courts on key issues including student aid, regulation, research funding, and tax policy. Our other speaker today is Ms. Katrina Del Grosso, as the head of the Mid-Atlantic Campus and Event Development at College Ave Student Loans, and is responsible for campus development in many states. Kat has been in the financial aid industry for over 30 years and was previously at the College Board, Syracuse University, University of Rochester, and in student loans. Kat earned her BS in economics from Penn State University, so I wanted to thank both of you so much for being here tonight with us. Before we begin, I'd like to let everyone know that this is a webinar and it will be recorded and available to ASDA members through our website. We will take questions for the speakers throughout the webinar. Questions can be submitted by any time through the Q&A function on the screen that you can see. I'll now turn it over to John, who will share information on the changes to federal student loans.
Thanks so much, Pyle, and thank you everyone for joining tonight. I'm going to talk a little bit about what the changes in the law were that we saw as a result of the One Big Beautiful Bill Act as it relates to student lending, with a particular focus on what it means for graduate education. And to do that, I'm going to pull up some slides, so bear with me while I bring those up. And hopefully everyone is seeing that now. So I think first things first, talk a little bit about the process of the One Big Beautiful Bill, and I won't spend a lot of time on this, but there are some things that are important to know as we talk about what the changes that were made were. The One Big Beautiful Bill, as it is named, HR 1, is a reconciliation bill. That makes it a somewhat unique piece of legislation. It allows the legislation to move through Congress with just a simple majority of votes in both chambers. Normally, certainly in the Senate, you need 60 of 100 votes to pass any legislation. The reason this was done is that Republicans do control both the House and the Senate, but they don't have the majorities big enough to pass bills through regular order. So this became a very partisan bill. It reflected the viewpoints, particularly of congressional Republicans, because Democrats were effectively locked out of the process. What's really important also about this bill, we'll talk about this when we get into the changes, is that it was done with the intention of making big changes to higher education, primarily to reduce the overall spending on higher education and to essentially pare back benefits, generating savings by reducing government spending in those areas. So additional spending could be used in other areas, primarily around tax policy. The other thing to keep in mind as we talk about these changes is the bill was signed into law, as Pyle mentioned, on July 4th of this year. There will be an implementation process I'll go into, which is required by the Department of Education, federal law, to make these changes effective and active. And that takes a little bit more time. But the bill itself sets timeframes of a very rapid order. Essentially, all of the changes as it relates to student aid, for the most part, need to take place by July 1st of next year, which is the start of the federal financial aid year. So things will be moving very quickly. There won't be, as is often the case in federal law, more of a period to sort of ease into or have a transition period. And these will be impactful changes. So we will look at what those changes are. And one of the things to keep in mind is that while the House of Representatives, when they put their bill forward, had changes to both undergraduate and graduate student lending, the final version of the bill, which was essentially what the Senate produced, only focused on making changes to graduate level borrowing. And there's a few reasons for this, but the primary one, and this may not be your experience as students, but there's a widely held belief in Congress that there is too much borrowing by students at the graduate level. There is a particular concern among members of Congress about master's degree programs. So there were efforts put into place, and the overarching structure of these changes was the idea that they would both reduce the amount of benefits available, which would save the government money, but they would also do some things that they believe would help to curb borrowing overall. And they did that in a couple different ways. The first is that they divided the kinds of borrowing graduate students can undergo by dividing graduate students into two tiers. The first of those tiers, and this is a little bit confusing, I admit, are known as graduate students. And what the law says is essentially graduate students are students who are enrolled in post-baccalaureate programs, so not undergrad, programs of 3 years or less scheduled course time. What they were really targeting is master's programs. They're trying to set a differentiation between master's programs and the second tier, which they call professional programs. And when you talked with the Senate staff, to their minds, it was very, very clear that a master's program would be a graduate program, and then something like a DDS or an MD or a JD or an MBA and certainly a PhD would all be considered professional level programs. That distinction isn't just semantic, it has real impacts on what borrowing students can pursue, because there are new limits on borrowing effective as of July 1st, 2026, that will take place. If you are a graduate student, again, this is 3 years of scheduled course time or less, you are eligible to borrow up to $20,500 in 1 year, with an aggregate total of no more than $100,000 across the life of your loan if you have not previously borrowed for another graduate program before. If you have borrowed for another graduate program before, if you're going back for, say, a second master's, your prior borrowing is subtracted from that 100,000, so you would have less than that 100,000 available to you. The other tier, professional students, the borrowing limits are higher. What you can borrow on an individual annual basis at the professional level is $50,000 a year, with an aggregate maximum of $200,000 per year. Again, the same deductions. If you've previously borrowed for graduate education, that's reduced from the total. And then you can add to it, on top of that 200,000 or 100,000, the maximum borrowing amount you would have borrowed as an undergraduate. So across the course of your academic career, were you to borrow the maximum in undergraduate, which is about $57,500, and then borrow the maximum at the professional level, certainly a possibility in dental education, you would have a maximum federal loan of about $257,500. Again, it'd be $157,500 for graduate students. These are significantly less than the current levels, which are provided in the current Grad Plus program. Currently, Grad Plus allows students to borrow up to the cost of attendance, which varies by institution, varies by program. These are hard, both annual and lifetime caps on borrowing. As mentioned, all of these changes to the law, the borrowing limits, are the elimination of Grad Plus, are set to take effect as of July 1st of 2026. The path to get there is going to be a little bit difficult because there's a lot of unanswered questions. We'll talk about that in a second. But all of these effects are essentially intended to go into effect for the academic year that starts in the fall of 2026. Given all of the other changes, there are a few exemptions that are worth knowing about as graduate students. The first is that if you are currently a graduate student who borrows within the Grad Plus program, if you have 3 years or less of scheduled course time, essentially if you can effectively complete your degree within the next 3 years, you can continue to borrow from Grad Plus. You are grandfathered into Grad Plus. Students who will be beginning in the fall of 2026 won't have that option. Grad Plus will not exist for them. But if you are currently a student, as I assume many of you are borrowing in that program, you'll have at least 3 more years to do that. The other exemption that, and sort of misleadingly here on my slides, that was taken away by this bill is the current exemption for loan limits for students in the health professions. And this is an interesting one in part because there was a lot of effort, certainly by ADEA, by the American Association of Medical Colleges, the American Medical Association, other groups around the costs of medical and dental education, and preserving that exemption in place. By most estimates, the 200,000 aggregate cap, the $50,000 annual cap, will probably be insufficient for a lot of borrowers pursuing advanced medical degrees, veterinarians certainly too. So there had been a lot of pressure on the Senate and in the House to resume that exemption. There will be a lot of requests for that to be added back in. It's very unlikely to be added back in, at least in the next year. It would likely take a new act of Congress to do that. The other change to loan programs, and this may apply to some of you, is that the existing Parent Plus loan program, which allows parents to borrow on behalf of their students, their children who are students, that program has been preserved, but it also has new hard caps in place. Parents can borrow annually up to $20,000 on behalf of their children, and then the aggregate limit for that is $65,000. Again, it does provide some additional leeway for students who may not be able to borrow their full cost of attendance under these new limits. But again, this is an area that came very close to being eliminated entirely. There's a lot of concern among policymakers about parents taking out loans for their children based on what we've seen, the pattern in that borrowing, that there are a lot of low-income parents who are not seeing their economic circumstances improve with parent loans, but are taking on debt. So the fact that it remains somewhat of a surprise, it does give a little bit of extra leeway for additional borrowing. The other big area of change, and this as current students won't impact you, but when you graduate will, there was a very substantial change to the repayment programs that exist. Currently, depending on how you count them, there are up to 13 different federal repayment plans. This bill would essentially eliminate all of the existing repayment programs and consolidate them down to 2 basic programs, an expanded standard repayment program where your payment is the same every month. The time frame for repaying that, the current standard plan is 10 years. This plan would, in 5-year increments, allow you to pay over a longer period of time based on how big your debt amount is. So the larger the debt, the longer the repayment window, but it's a fixed monthly payment. The other plan is a revision of the existing income contingent repayment plans and income-based repayment plans, plans that essentially ask you to pay a percentage of your salary with certain protections as to that amount. There's a number of those plans currently in place. This would replace all of those with one simpler, not necessarily simpler to calculate, but only one income-based repayment option. Finally, around repayment, something certainly worth noting. In the Public Service Loan Forgiveness Program, there had been a push to get the period for medical and dental residencies counted towards periods of employment for public service loan forgiveness. For those of you who may be familiar with this program, essentially it was passed into law in 2008, and it requires students to make 10 years of consecutive on-time payments to their loan on their student loans if they do that while working for a qualified employer. And a qualified employer is a nonprofit organization, 501c3, or government. Then they will have their loans forgiven at the end of that period. There had been an effort to get the time spent in residency counted as employment for those purposes. Unfortunately, the bill did not include that provision. So those periods of time in residency will not be counted as employment under public service loan forgiveness. And then finally, I touched on this earlier, but the implementation aspect of getting this law into effect is going to be pretty significant. It is a big, complicated law. It also moved very quickly. So a lot of the language wasn't very precise. there's a lot of unknowns. I talked about the idea that they've divided all graduate students into graduate or professional groups. There's a lot of degree programs that cross those lines, or where it's not entirely clear what constitutes professional versus graduate. The way generally the government deals with this is that the law gets turned over to the executive agencies that will implement it. They will do what's called a rulemaking process, where essentially for the Department of Education, they gather different stakeholders to talk about the law and what those changes mean and resolve all the unanswered questions, the gaps, and the gray areas in the law. The Department of Education has already moved forward with starting that process. They've asked for nominations for people to serve. That closed just last week, the deadline to submit for that. And we will likely see regulations finished and issued by the Department of Education in the spring of next year. That is going to be a problem for a lot of reasons. We can talk more about this in the questions, but as I mentioned, if all of these changes are set to take effect in July 1st of 2026, not having finalized what those changes will actually mean and the details of them until the spring of next year at the earliest gives students and institutions very little time to understand how to change their borrowing, needs, how to package loans in a way that reflects individual student circumstances. And so as a result, organizations like my organization, AC, and others have been pushing Congress to make some changes, pass a technical fixes law that would address some of the concerns, some of the ambiguities, or at a minimum, issue guidance to the Department of Education clarifying what their intent was to avoid some of the problems that students and borrowers might face as they try to determine what they will need to do in the next year. Obviously, a lot of this quite complicated and varies a lot on individual circumstances. I know that we will have time at the end to talk in more detail about specific questions you might have. And I appreciate you taking the time, and I'll be back with you a little bit later.
Awesome. Thank you so much, John, for providing all this information. I know I learned a lot about the pivotal changes and how they're going to be affecting me. As a reminder, questions can be submitted at any time through the Q&A function, and we'll have time for our speakers at the end to answer all of those questions. Now I'd like to turn it over to Kat, who's going to discuss some alternative borrowing options for us.
All right, thank you, Kyle. All right, so thank you again for joining tonight. So I work at College Ave Student Loans, which is, we partner actually with ASDA with a special private loan, some special private loan benefits that are specific to ASDA students. So I wanted to go over kind of some of the differences with John kind of covered all that all the 30,000 foot view stuff that's going on in the industry, the higher education industry in general. And so we thought it might be helpful to kind of take a look at what is the difference between federal and private loans. So let me go through that with you. As we said earlier, I've been in the field of higher ed for over 30 years. Financial aid is like my thing. So I've been helping students for a long time. So throw any financial aid questions at me at the end, and between John and I, we can answer your questions. So the federal loan programs, John just talked about how the Graduate Plus loan program is going to be going away, except for the grandfathering out of students' Grad Plus loans after July 1 of 26. The Grad Plus loan is a federal loan. Everything John discussed is a federal loan program. So you have undergraduate loans, graduate loans, professional loans, of which, they're called different things, but they're either federal direct loans or they're plus loans, essentially. That funding is all coming directly from the federal government. Whereas on the private loan side, these are essentially, sometimes you'll hear them called alternative loans, but they're really private educational loans. It's all semantics in terms of how you phrase them, but we typically will call them private loans in this industry. That funding is actually coming from banks or credit unions or private lenders like College Ave. So in terms of how to apply for federal loans, and if you are a current student, you may have already applied for federal loans during your time in school. If you're you know, or you're newer to it if you're earlier on in school, but nonetheless, in order to apply for any federal loans, you have to fill out what's called the free application for federal student aid, otherwise known as the FAFSA, for my acronym here. So you had to apply every year through the FAFSA in order to apply for whether it was a federal direct loan or a federal parent loan for undergraduate students, which is the plus federal plus you see there, or the federal grad plus loan. So all of those require the FAFSA to apply. You don't have to be credit worthy for the federal direct loan itself, but for the plus loans, there is a credit worthiness piece to it. It's not very rigid. It's quite frankly, it's very easy to be approved for a plus loan, whether it's the Parent Plus or the Grad Plus program. So there's not a lot there in terms of credit worthiness, but there is a tiny piece. And so that exists on that side. If we're looking at the private loan side, however, there's no FAFSA required because it's not a federal program. So it's not part of the federal student aid program. So what you would really be doing is applying through private loans through those banks, credit unions, or private lenders' websites. Typically, the colleges and universities that you attend will have a structured, a lot of them anyway, will use a structured, guidance or portal for you to be able to at least find some options for you that might be best. As I said, College Ave does have a specific loan we have an undergraduate student loan and a dental school loan that have specific borrower benefits for ASDA members. So we do have some perks that are different than our off-the-shelf products. But anyway, we do look at credit worthiness. So that's the difference there on that piece. Then, in terms of interest rates, so the federal loans have a fixed interest rate that it's set technically it starts July 1 of any given year. So it's only good for that one academic year, essentially, July 1 through June 30. So anything that you borrowed through that time frame would have that same interest rate. So for example, if you were borrowing this year, if you took out the graduate unsubsidized direct loan, the rate is 7.94%. If you took out either of the plus loans there, whether it was the parent loan or as a graduate, as a professional student, you borrowed through the grad plus loan, that rate is 8.94%. So those are set for this academic year and they change every year. So it'll be, this year it went down by about 0.5%. But last year it went up by about 1%. So it was a lot. So it rolls with the tides. It's based on a T-bill. So in addition to that, for the private loan side, those are going to be fixed and variable interest rates that are based on whatever. Honestly, it's based on the competitiveness of the marketplace at that time. So banks, credit unions, private lenders, they're all sort of competing at the same time. So there's a lot of competitiveness in terms of the interest rates, but they tend to offer either fixed and or variable rates. So you'll see a variety of rate ranges for the programs. Okay, in terms of fees, so the federal loan programs charge an origination fee or an application fee. So think of it as kind of like an upfront fee. So if let's say you borrowed, I'll use $50,000. If you borrowed $50,000 this year, the rate that they charge is 1.057%. So right off the top, $528.50 slices right off the top. So you don't get that money. You would get $50,000 minus $528.50 for your school that year, for your program that year. So that's the federal loan program, the direct loan. If you borrowed through the Grad Plus loan program or the Parent Plus loan program, those origination fees are much higher. They're actually 4.228%. So if you were to take out, let's say you took out a Grad Plus loan this year because you're in school, so you're able to borrow it before the program goes away. Let's say you borrowed $100,000 through that Grad Plus loan at a 4.228% origination fee. That's $4,228 that doesn't come to you. It just goes directly to the government. So you're netting $100,000 minus 4,228. So that is the way the program is structured today, and it always is, quite frankly. I mean, it always has a fee. So I've been around a while. Like these loans have had origination fees, quite honestly, since I think I've been in the business. So federal loans typically have the fees. The private loans, on the other hand, don't have fees most of the time. It's very rare that I see private loans with the origination fees. However, as a consumer, you do need to do some shopping, at least, over the next year while you have the options of Grad Plus and versus private loans. You have the opportunity to shop and see, well, which rate is best for, which rate is best for me, in addition to the fact that I might get a zero fee, but my interest rate might be a little higher. How does it come out in the math? And so it's going to be important for you, whether it's this year or after July 1 of 2026, like John was talking about with the changes. It's always good as a consumer to look at, okay, the fees and the interest rates matter, mathematically speaking. So you'll want to kind of look and see what's best for you. Also, the funds are dispersed directly to your school, whether it's a federal loan or a private loan, typically. There are minor exceptions, but it's not, it's pretty normal that private loans will disperse directly to your school, just as a general rule. And then lastly, on the private loans, often they have cosigners, but to be honest with you, at the graduate and professional level, you don't always have to have a cosigner. However, you'll probably get a better interest rate if your cosigner is strong. Like if you want to try to get a better interest rate, that might be something to look at, to add a cosigner onto the application to get you a better deal financially speaking. But they're not always required. It's just that you'll probably end up getting maybe a little bit better price, but it's worth looking into before you sign on the dotted line. And then sometimes there are loans available for in the private loan sector or area, if you will, that are the parent or a creditworthy person can borrow on your behalf, as opposed to like they're actually borrowing the loan and you're not on the loan at all. So you do have some of those options available to you where someone can borrow on your behalf through the private loan side. Okay, so that's kind of the back-to-back comparison. So these are, I know this chart has a lot on it, but I've really kind of bottom lined it for you by highlighting in the turquoise or the bluish color, the changes that John mentioned. This is where the rubber meets the road in terms of the dollars. So everything else that doesn't have the shading is going to be the same, whether it's this year or after July 1, 2026 for that year. So let's focus on the blue here. So the undergraduate Parent Plus loan, if you're in the undergraduate sector here in terms of taking your classwork now, the maximum the parent will be able to borrow on your behalf is $20,000 annually, but the most they can borrow will be $65,000 total. And you may say to yourself, well, that's not very much, because you're going to dental school, you're going towards dental, you're in that track. You figure if you take 20,000 out in 1 year, 20,000 out in the second year, you've already, you're and 20,000, or you're already going to only have $15,000 left in your third year. So that's a big change, but more substantially for you folks, going on to take on, higher level work here. The unsubsidized graduate loan, the cap is going to be $100,000, which John spoke of, and also on the graduate health and professions loan side, your cap is going to be $200,000. And you can see there, comparatively speaking, that those dollar amounts are less than what they are today. So, in terms of your aggregate, basically is your lifetime limit there. So that's what that means. And then, as he said, no new borrowers on the Grad Plus. You do have a lifetime borrowing cap now, for starting July 1 of 2026. Right now, there were no lifetime borrowing caps, but it is going to change to $257,500 through the federal loan programs. So those are the changes, or just from a dollars and cents. Okay, so just so you're aware of the program that College Ave has for you folks who are members of the ASDA. So we have the dental school loan and the undergraduate school loans. The borrower benefits that we offer are beyond our off-the-shelf products, as I mentioned. We offer a 0.25% interest rate reduction for all of all the loans you're taking while you're in school. In addition to that, after you graduate, we give you a 1% principal balance reduction on your loans. It's as a statement credit. So it's basically like, okay, if you're taking out a large sum of money, 1% of that is going to, really matter. And that will be a statement credit towards you right at the beginning of your repayment. In addition to that, if you use your bank account to take auto debit payments out of for your payments each month, once you hit repayment, well, actually, you can sign up right away. You can even get that extra 0.25% interest rate reduction as soon as you borrow. I mean, so while it's accruing, you're getting that extra 0.25% interest rate reduction. So you've got a 0.25%, the 1%, the 0.25 again. And then we do have some cashback rewards while you're in repayment as well that allows you to kind of, just get some extra cashback rewards they go towards your student loan payments as well. So that's through a program called PACE. So we just need you to, if you are looking to go the private loan route, which again, like it's for this year, you may actually be able to borrow through a lot of the federal loan side, of course. It's really what we wanted to do is to give you some direction as to, well, what do I do after that? If the Grad Plus loan program is going away and I can't, I don't have, if you're grandfathered out within 3 years, if you're not going to have enough, then we wanted you to be educated on what is out there. So we do have the two portals to apply. They're listed here. One is the, dash dental at the end. The other one is dash UG for undergrad. So those are available to you. Couple other things on the dental school loan I wanted to mention specifically is that differentiates this program from other other graduate and professional loans out there that are in the private loan market. First of all, our total loan maximum is $500,000. That includes all educational loans, but it is a sizable aggregate loan limit. So, given the average dental school borrowing in the, I don't know, $300,000 range and beyond, up, down, all around, hopefully that would be able to cover you in terms of your federal and private loan indebtedness. Also, we have a longer grace period for students. We offered a 12-month grace period instead of a regular 9-month grace period for our regular graduate loan. And in addition to that, we offer up to 2 years of deferment. So like while you're trying to get on your feet in terms of maybe building a business or building your cash flow and your things like that, we do allow up to 24 months deferment as well beyond that. And then the other thing is that we do have the most repayment options available compared to other private loan lenders. We offer a length of time up to 20 years for the dental school loan, but also we have multiple repayment options, things like paying interest only or deferring the whole thing while you're in school or making, $25 payments during school just to kind of get in the habit of paying and things like that. So we have more repayment options than other lenders. So we think that you'll find those amenable to your needs while you're enrolled in school. So those are the, kind of the high level summaries of the programs. The other thing I wanted to mention is, so here's the difference. Basically, when you apply for a federal loan, I mentioned this earlier on that slide that was like a comparison slide. There's credit worthiness to apply for a Parent Plus or a Grad Plus loan right now, but it's not really a whole lot of parameters to be approved. Once the Grad Plus program and goes away, and you are maybe looking on the private loan side, just note that it's kind of like, you know, when you and I go to buy a car, or you and I go to, you know, get a mortgage, or any kind of credit card, anything like that. There's a credit worthiness piece underneath there, and so the importance of credit with private loans will be good for you to know now, because the day that when the day comes, or if the day comes that you think that you will need that beyond the Grad Plus changes, it'll be better for you to kind of have your credit in better shape than, you know, take a look at it now to figure out, okay, do I have any issues with it? Check your credit report. You can do that for free at annualcreditreport.com. You can check it weekly if you want through all three credit bureaus at annualcreditreport.com. And you know, monitor that and see if there's any errors on your credit report. Just make sure that you're kind of getting in good habits as you might be gearing up to maybe need a private loan, whether it's now or later. And so credit scores basically that are produced through your credit report, the credit report basically produces a score, if you will. Those scores indicate to lenders like College Ave and to any bank or credit union the likelihood that you'll repay us. So that credit score is important, and a lot of time, well, most times really, the lenders aren't just looking at the score, but they're looking at, okay, have you been paying back? Are you, you know, are you late on payments? Are you in bankruptcy? Is there a foreclosure? Is there anything derogatory and things like that? They're looking at the holistic view of the borrower, not just one score at most lenders. So they're looking at a bigger picture, but nonetheless, the score is important, and it gives us a numeric value as to how likely it will be, you know, for and to take on the risk of giving you a lot of money that we would like you to pay back eventually. Stronger credit generally results in better interest rates and loan terms. So when you're applying, the better your credit is when you go to apply for private loans, you'll probably end up with a cheaper, you know, overall cost. And then if you have a cosigner, it can certainly improve results sometimes. If the cosigner is strong, then they can probably help you get a lower interest rate. As I said, these are mostly zero fee loans, so it's not about the fee. It's really more about the interest rates, where the cosigner can kind of help you get a better rate. And then while you're in school, my advice to you would be to, you know, try to build good budgeting habits. So now's a good time to do that while you're still in school. Don't wait until you're working in, you know, a dentist, or you know, doing in your field in dentistry. You know, work on that now to build good budgeting habits, so you know that you can be in good shape when you are finished school. And then lastly, there are available calculators that are we have we have several on our website. I threw up a couple pictures here for you, but that website there, collegeapp.com/calculators, you can try out different loan amounts to see kind of what repayment amounts might be based on the interest rates that you're seeing when you're applying for private loans. So that is pretty much those are my prepared slides. And so now I think I will send it back over to Pyle so we can go through some questions.
Yes, perfect. Thank you so much, Kat, for all that information. It's comforting to know that there are so many options to help dental students obtaining funding, especially throughout dental school, with kind of the changes that are happening this year. So I will move forward with our questions, and our very first question is going to be, do private loans offer income-driven repayment programs?
I'll take that one. So private loans, so okay, now this is the interesting thing. So when all these changes have been coming at they've been coming at us, I guess, if you will. And then July 4th, when the One Big Beautiful Bill Act was signed, here we are. So we have, we meaning College Ave, but also we meaning the private lending community have been sort of feverishly working on, okay, what do our private loans need to look like now that the federal program is going to be going away. And so I think what you will see is that there will be income-based repayment plans come out of some of the programs, even if you don't see them today. It is highly likely that you will see them as we go down the pike. So there's a lot of unknowns right now because it's fresh news, if you will, given that we're only a couple months in. So while you may look at some of the lenders' websites now, and they don't have income-based repayment, I think by the time we roll on to a year down the road, I think you will see some.
Great, thank you so much. Our next question is, should I pay interest accrued during dental school if I can afford it?
I'll take that one. Or do you want to take that one, John?
No, go ahead.
Oh, okay. Yes, if you can, absolutely. So the overall cost of, it's kind of like, I'll compare it to, if you were going to go to buy a car, if you put more money down in the front end, then you're going to pay less overall in the end on the car. So it's honestly, mathematically speaking, it's the same thing. So anything that you can put towards it, whether it's $50 a month, $10 a month, I mean, it really doesn't matter. There is no prepayment penalty. So if you can afford even just a tiny little bit, it's just going to kind of quietly over here, reduce the overall cost of the loan. And when you get out, you'll be like, woo, I'm so glad I did that. Okay.
Our next question is, if I start as a D4 next July, meaning that they have one more year of Grad Plus, and then a 2-year residency right after, will the residency count for the 3-year grandfathered in rule?
So I should preface specific answers to things by saying I'll refer back to the implementation period. A lot of these areas are those kind of gray areas in particular where we want to have clarity through the federal regulatory process. What I would say is, since it is, and I don't want this to be taken as gospel, but since it is a formal academic program of less than 3 years of length remaining as of June 30th, 2026, the law says that you should be able to be grandfathered in for those 3 remaining years of academic course time. If, for instance, for whatever reason, you had 2 more years remaining before the transition to the 2-year residency, that would be a 4-year window. That would say that you would not receive the grandfathering because you would need to be within that period. But based on at least the question that's being asked, it seems like they would be eligible to be grandfathered in for Grad Plus.
Awesome. Thank you so much for that. Our next question is going to be, aside from the Department of Education's rules, can we expect to see other changes to student loans from Congress?
At some point in the future, sure. I don't think we'll see anything significant. The one area where is the possibility of additional changes to the law would be around the sort of things that I was talking about earlier with like a technical corrections bill, where rather than sort of changing any of these terms, the limits won't change, the expiration dates won't change. You get further clarity from the congressional staff and statute as to what they want these provisions to mean. Maybe more guidance around the difference between graduate and professional, some other areas of policy that are kind of ambiguously written that we'll get that. But certainly they've changed everything about student aid and student loans and repayment and accountability as a huge overhaul of the federal policy around student borrowing and student repayment. So no, we've got more than enough to deal with. Nothing else on the immediate horizon, thank goodness.
All right. Thank you so much again for that. Our next question is, as a pre-dental student, what can I do now to set myself up for success financially?
I mean, I'll start just by echoing what Kat said. I think being very thoughtful about what you can afford, what your options are, what the costs you're taking on, and how to balance that and having a plan, looking at what are the options, certainly considering options, both in the private and in the federal sector in terms of what you can do. We're still sort of puzzling our way through what some of these changes are, but certainly the more financially aware you are of what are the options available to you, working with the financial aid office at your institution to help navigate some of those changes. And then certainly whatever you can do, to Kat's point just a little bit earlier about if you have the possibility to reduce your borrowing, not necessarily to borrow up to the maximum, if you have the ability to pay down some debt earlier, that's always to your benefit. But Kat, I bet, has some better insights in that area.
Right, that's great. Yeah, I mean, I think learning, here's the thing, like when you were younger, like not everybody is taught sort of certain budgeting techniques or about financial literacy and financial wellness and things like that. And so sometimes when students hit college, that's when they're first starting it, if they really didn't have any guidance prior to that. And if you did have guidance prior to that, awesome. But to be honest with you, a lot of students don't. So the earlier that you can kind of, use free budgeting apps or, to sort of start practicing budgeting, definitely looking at your credit. Because even if let's say, for example, you have a credit card, or you have maybe your parent, if you had a parent that put you as an authorized user on their credit card, that helps to start building your credit. Any federal loans that you've been taking out, building your credit. So it's good for you to go look at your credit report. So there's 3 bureaus: Experian, Equifax, and TransUnion. And when you go to annualcreditreport.com, which I said you could get for free, don't use a different site, because if you're paying for it, then it's not the site I'm talking about. This is the governmental site that's free for everybody. And you can look at all 3 of those companies' results. Those are the 3 main credit bureaus, if you will. And you can see what your credit report is. They should ideally match-ish. But to be honest, like having been out here a while, my credit file is a little thicker than you guys, just because I'm older. But it's basically important to go see, oh, well, first of all, is there an error? Like if one of the bureaus has it correct and the other 2 don't, I need to fix that. And you can't fix it on a dime. So like if you have a year to lead up to fixing it before you might actually need to go buy a car or get a private loan, you'll thank yourself a lot, because it's not always quick to, fix that stuff. So, but anyway, building good credit is important in life, period. So.
Amazing. Thank you both for your insight on that question. Our next question is, can we take the max amount of federal loans and then bridge the gap with private loans?
Yes. So that's what happens today, essentially. So today, depending upon how much school costs, whether it's someone going to, quite frankly, to a 2-year public community college all the way up, although those folks don't really, their cost of attendance isn't as high. Let's call it a 4-year, school where you're an undergraduate, all the way up to going to dental school and the amounts needed. There's a variety of things that families do. So you either pay for college through your income, your assets, or loans. I mean, those are kind of the 3 main areas. So if there's financial aid, great, you get that. But everything else, the balance that's due, comes from income, assets, or loans. So the loan part of it, you want to not overborrow, like John just said. Only borrow what you need. And you can do a combination of things, but borrowing through the educational loan piece may at least tie you to some better options than, let's say, using like a home equity loan or a personal loan through a bank or something like that, because at least they're educational loans and they do tie to repayment options that might be better for you as a student, or as having one that is just graduating or something. So definitely use a combination if you need it.
Great, perfect. Thank you. And then our very last question for tonight's webinar is going to be, are there opportunities for a one-on-one guidance kind of session from College Ave if I borrow from them?
We have our regular customer service folks, of course, who would help guide you. I'm not sure. Pyle, is this presentation being made available to everyone who, okay. So, I mean, I had the contact information on that last slide that had my picture on it. So in general, we can definitely help in that sense. We also have I didn't focus on it per se, but on this, oops, on this last slide here, we have a resource page here, collegeapp.com/ASDA-resources. So we also have that available. I would say that I could offer, but my bandwidth is a little, have to be careful based on, my bandwidth, but certainly we want to make sure that you get the help that you need. So I would say if you need advice, the borrower services number for when you're trying to apply for a loan that ends in 7502 there, that is the best place to start. And then, that additional resource URL address there. And then we'll go from there, and hopefully we can get you to the right advice.
Perfect. Thank you so much for answering that question. A special thank you to our speakers for sharing their insights with us today. Don't forget to follow ASDA on Instagram to find out all of our latest ASDA happenings, event registrations, and more. The handle is @dentalstudents, and the direct link can be found in the chat below. I know they will be linking it. ASDA is here to support you throughout your pre-dental and dental school journey, so please reach out to us at membership@asdanet.org with any questions that you may have. And please visit asdanet.org/join to become a member. There will also be a link in the chat for you. Thanks again for participating tonight, and a special thank you again to our speakers, John and Kate, for kind of, spending your evening with us. And so thank you for answering all of your questions, or all of our questions with everything, and I hope you have a great evening. Thank you.
Thank you, Pyle.
Great, thanks so much.
Take care.